Good evening, everyone. Today we are going to cover topics around bonds, bond price valuation, or fixed income valuation, as we call it in the industry. Concepts of the yield curve, different kinds of yields, why are those yields used? So these are some of the topics which we intend to cover today. Very quickly, once again, just one second. So can I say when we talk about a bond, right? A bond is very similar to a loan. Okay. In a loan, as we know, there are two counterparties. There is the borrower and there is someone who lends. And in most cases, it could be a bank, right? Cash flow diagrams are very important when it comes to understanding securities, understanding how to price securities. So it's very important that we understand cash flow diagrams. So in a loan, the cash flow diagram looks very straightforward. At time zero, can I say the bank is going to lend money to the borrower? So borrower says a retail or a corporate, whatever the entity is. So the borrower is going to get some money from the lender, and can I say that's the principal of the loan. So at time t equal to zero, this is how the cash flow moves from the lender to the borrower. In terms of a cash flow diagram, which I'm drawing at the bottom, the cash flow diagram looks like this. So the borrower is going to receive a cash flow. Always in a cash flow diagram, whenever we draw upward arrows, those are cash inflows. And whenever we draw down arrows, those are cash outflows. So this cash flow diagram is from the perspective of, say, the borrower. And from the borrower's perspective, can I say it's a cash inflow which comes? Similarly, from the perspective of a lender, can I say the cash flow diagram is going to look opposite, completely the opposite? So from the uh, perspective of a lender, the cash flow diagram has a negative cash flow at time zero. On the x-axis is time. On the y-axis is the cash flow. Okay, so this is the principal of the loan. Can I say it will be plus P0 for the borrower and minus P0 for the lender? In a loan, typically in a bank loan specifically, at regular intervals, the borrower is going to pay the bank EMIs, right? So when I talk about any time which is greater than zero, there will be EMI payments which the borrower is going to make to the lender. These EMI consists of both interest payments as well as principal repayments. That's how typically a bank loan is structured. And can I say this is a cash flow from the borrower to the lender? So it's a cash flow out for the borrower. So when I draw the diagram for the borrower cash flow diagram, can I say these are these arrows? EMIs in the case of bank loans are monthly EMIs. So suppose you end up taking a 5-year loan, you will have to pay EMI every month. So your entire loan, suppose you take a loan of 5 lakhs, you need to repay it back in the form of EMI payments, which would be 5 into 12, which are 60 payments across 5 years. So all these are cash flows from the perspective of a borrower. So these are EMI payments. Obviously, the lender is going to receive them. So it's a cash receipt or an inflow from the lender's perspective. So we will draw these small arrows, which are called as EMIs. Also, the way EMIs are structured are that EMIs are the same across every month for the tenor of the loan. So the EMIs don't change, and hence EMIs present a stream of cash flows which are constant in nature. Unless and until the interest rate on the loan changes, these EMIs are going to be constant. So cash flows are going to be constant. And this constant stream of cash flows for a certain given period of time is also in time value of money called as annuity stream, which means a constant uh, range of cash flows, same cash flows spread across time. So these are also called as annuity streams or annuity stream. So these are the cash flow diagrams from a loan perspective. Very straightforward. Bond is very similar. Bond is nothing but again a loan, but it's something which is traded in the markets. So why a bond would be issued? So typically there again is a borrower and a lender there. Okay. A borrower could be a corporate who is in need of money or finance or funds. It could also be a government who wants to sponsor a project and needs funds for the same. So corporate government institution who wishes to borrow money will typically issue a bond to the lender. Lender in bond markets is also called as investor, by the way. It's not called as lender, it's called as investor. So the investor and the corporate or the government who's the borrower in the bond market is called as issuer. So the issuer is going to issue a bond to the investor, and the investor in turn is going to buy. So this is going to be the cash flow, which is going to be uh, exchange between the issuer and the investor. So at time t0, once again, there is the issuer on the bond and the investor in the bond. These are two counterparties to a bond. Uh, Anyone who's in need of financing of a project or financing for different reasons, typically called as the issuer, will tap the debt capital markets. So how is this bond sold? This is sold through debt capital markets. Yeah. And there could be several, intermediaries like investment banks who could help sell these bonds for the first time to the investors from the issuer. So issuers are going to hire investment banks who are going to act as intermediaries, and these intermediaries will help the issuer list these bonds on exchanges and trade them for the first time. And once they're traded, then we say that the bond is traded in secondary markets. So the entire function is called as debt capital markets, in which the first step is to list the bonds, and your investment banks or other intermediaries will help you do that. Once the bonds are listed on an exchange, then these bonds are set to be traded on secondary markets. And these are basically exchanges. So then anyone can buy or sell these bonds once these are listed. So at time zero, the cash flow is exchange is very simple here. Investor is going to pay cash to buy the bond from the issuer. And this bond is basically a promise from the issuer to the investor that, look, today I've borrowed money from you, and at the maturity of the bond, I'm going to return that money back to you. Yeah, so this is how it looks. At other times, greater than zero, uh, as far as the loan is concerned, there are interest and principal repayments which are done. In the case of a bond, only interest payments generally are done. And that's a regular bond which we are talking about. So in that case, the issuer is going to pay interest, regular interest to the investor, and that interest in the bond market parlance is called as coupon. Yeah. If we were to find or form the cash flow diagram from an investor perspective, so from an investor perspective, the investor is going to pay out cash, so it's a cash outflow. You're going to pay the price of the bond to enter into the bond, and then at regular intervals, you're going to receive interest or coupon from the issuer. So this is how the cash flow diagram looks like. And at maturity, which is time t of the bond is structured that the issuer has to pay back this cash, or also called as face value of the bond, back to the investor. So hence you have a big up arrow here, or cash inflow for the investor, which says that the investor is going to get back the face value, also called as par value of the bond, back from the issuer, and along with some coupon payment for that period also. So this is a typical cash flow diagram of a bond. And the reason why I've introduced this is because a lot of pricing for regular fixed income as well as other kinds of structured products are based on futuristic cash flows. So whether you're valuing an equity security, debt security, or a structured security, at the end of the day, it's all about knowing what the cash flows are, future cash flows are, and then trying to find their present values today, because we're always interested in finding or knowing what is the value today. Yeah. So all these cash flows ultimately would need to be discounted back to today to find the value of the bond. Okay, which we will do in some time. But this is uh, a typical cash flow diagram. All cash inflows are upward arrows. All cash outflows are downward arrows. Any questions on this?
No, sir.
Anyone? Okay. All right. So bond versus loan. These are the mechanics. This is the cash flow exchange and the cash flow diagram in one slide. Okay. Now let's get down to business in terms of understanding how to price this bond. So when an issuer hits the market or wants to list this bond on the market or on the exchange, at what price would it list, right? So that's very important to understand. So for that, there's a simple diagram. Once again, this is the same cash flow diagram for the bond, which we had drawn here. So this is a blow up of that. And here what we have is, if you want to find the price of the bond today, that is basically very simple. That's the present value of every futuristic cash flow. So any financial instrument which you want to value, all that you have to do is you have to find the futuristic cash flows, which could be simple in this case, because we know that to every bond there's a certain coupon rate which is attached. So we know for sure, okay, these are going to be the cash flows. If the issuer is not defaulting, then for sure you're going to get these cash flows. But in other kinds of securities, these cash flows might have to be forecasted, which is not an easy exercise. So valuation is not easy. But in the case of fixed income, valuation is easier, because in most cases on most bonds, coupon rate is known and hence coupons are known in the future. So in year one, year two, so on and so forth, you keep on earning the coupon. In this case, we call it as PMT, constant payment, PMT. And in year till year end, you end up getting the coupons, which means every year you are earning interest on the bond as an investor, and which is why we have a cash inflow every year that we are showing here. Also, at maturity of the bond, you get back the par value, which means the face value of the bond. A lot of times, face value of the bond is 100. So you get that 100 back at maturity. So that's a big cash flow you have along with the coupon. And how would you then find the value of the bond today? So the value of the bond today will be nothing but every futuristic cash flow you need to discount it back to today. So the year one cash flow you discounted back to today. Year two, you're going to discount it back to today. So all these coupons, you're going to discount them back to today. And that is given here. So all these cash flows, which you can see, which are discounted back to today to find their present values, are these terms. Okay. I'm just going to explain this in slightly more detail here. So let's also take a simple example. Okay. And try to make sense of it. So here is an example. So suppose we are trying to value a 5-year bond with a 10% coupon rate and with a yield on the bond as 10%. So yield on the bond is nothing but the rate which you will end up earning on the bond. 10% is nothing but the coupon which you will end up earning on the bond every at irregular frequency. So we also are assuming here annual coupons, which means the frequency of compounding is annual, is what we assume in this sum. So 5-year is the maturity of the bond. Coupon rate is 10%, which is the rate, which is the interest or the coupon which is paid out annually. The market rate or the yield, as we say, the yield of the bond on the market rate on the bond is, say, 10%. And this is the rate which changes, fluctuates every day. Yield, the market rate or the yield fluctuates every day. So if I were to see a graph of, say, yield versus time, it could look like this. But coupon rate stays constant in a fixed rate bond. In a fixed rate bond, the coupon rate always stays constant, and say the par value of the bond is 100. So these are the various assumptions on this bond. And based on these assumptions, suppose if we were to carry out a valuation exercise, I'm going to show you in detail first, and then we're going to do this on Excel also. So these bonds, first of all, as I said, always draw the cash flow diagram. So the cash flow diagram looks like this. At time zero, the investor is going to pay the price of the bond, which is unknown. Can I say in this exercise, everything is known. What is not known is the present value of the bond or the price of the bond today. That is not known, and that is what we need to calculate. So this is not known, but this is the price which an investor needs to pay to enter into the bond. Also, every year there are coupons which will be paid by the issuer to the investor, and that coupon rate is 10%. This is always quoted annualized. So whenever in any bond problem you see a coupon rate, say of 5%, they will not always mention that it's annual, but this rate is always annual. So whatever is quoted will always be annually quoted. In fixed income, once again, if you see any coupon rate or you see any yield or market rate, all those rates are by default annualized quoted. All these are quoted annualized until otherwise mentioned. So you can assume that these are annualized, quoted. So 10%. Market yield is also 10%. But let's talk about coupon rate. 10% is the coupon rate which you earn every year on a face value of 100. On what principle? 100. That's your face value. So can I say if I were to calculate the coupon will be coupon percentage rate into the par value. So every year you earn 10% of the power of 100, which means that you earn $10 every year. So that's your coupon. So can I write the cash flow diagram like this now? So 10 is what you earn every year, and that happens till the maturity of the bond, which is 5 years. Additionally, at maturity, you also receive the par value back, which is 100. Okay, so this is the cash flow diagram. And now to find P0, what you need to do is you need to take every cash flow and discount it back to today. Okay. So how will we discount it back to today? We use very simple principle that if you know the value of the instrument today, and suppose that increases by the rate R, which is the market yield year, which we have taken in 1 year. After 1 year, can I say its future value becomes FE1? So whatever you invest today, you invest for 1 year. So you get back the principal, which is the factor one, and you also earn the interest, which is R percentage over that present value. So PV into 1 plus R will give you FE. So what is PV? PV is nothing but FE1 divided by 1 plus R. So this is from a 1 year perspective. So can I say the present value, the first cash flow in our case will be equal to future value 1, which is this cash flow 10 after year 1 divided by 1 plus R. And R in our case, can I say is 10%. So this will be the present value of the first cash flow. If we are taking the second year cash flow, can I say that the present value of that cash flow, which is PV2. If I invest it for 2 years, since I'm investing for 2 years, I will have invested it compounded at 2 years. So hence we have a square year because we're investing it for 2 years. After 2 years, you get FE2. So if I tell you that we have FE2, which is 10, what is the present value today? So you have to just move this factor on the other side. So PV2 is nothing but FE2 divided by 1 plus R square. And that's exactly what we will write here. When I discount this cash flow back, it becomes this 1 plus 10% square. And I can generalize this. Generalizing this, I can write PV of the nth cash flow is equal to FVN, which is the nth cash flow divided by 1 plus R raised to N. Here we are assuming annual frequency of compounding. Any questions on this? So every cash flow, we are going to discount it back using this formula ultimately. So this is the formula which we will use to discount back all the cash flows. Last year's cash flow, maturity 5, year 5 cash flow is 110. Please note coupon 10 and par value of 100. Any questions on this? Okay. Devanshi, any questions?
No, sir.
Yes. Okay. All right. Uh, we are now going to go to Excel and implement this. Okay. So let's go to an Excel. All right. So here we will put out all the assumptions of the cash flow, which were these of the bond. So these were all the bond assumptions. So we'll make a note somewhere here. So time to maturity on the bond is 5. Coupon rate is 10% on the bond. Okay. Then we have the market rate, which is R. Yield also, it's called 10%. And then we have par value as 100. So we make a note of all these assumptions. So this is the coupon percentage. Coupon rate, on the other hand, can I write that as coupon? And that will be nothing but your coupon percentage into the par value. Yeah, coupon percentage into par value. Now, an important, very important thing which I want to introduce here is how to name all these assumptions. Can I say these are all my assumptions in this bond pricing exercise? And if I want to name all my assumptions, which means I want to name this 5 as TTM, I want to call this 10% as R, I want to call this 100 as par. So for that, you always have to name your assumptions on the left and the values on the right column. Then select the name and the name which you want to give and the value to that name on the right. Then you have to go to formulas. You have to click on create from selection, and then you have to check left column. It means that it will create names from values from the left column. What does it mean? It means your values are in the right column and the names which you want to give to those values are in your left column. And hence we check left column, create names, press OK. What happens is in this name box, now you see all these which are put out here. So you have the coupon, you have the par, you have the TTM and other things. Okay. So what is the use of this coupon? I can write it as, say, C percentage, which is this value. Also, Excel doesn't store the special characters. So percentage is treated as a special character. Blank is also a special character. It's not stored separately as a special character when you create a name. So Excel will store that as a underscore. So suppose if I give C underscore C space coupon. Suppose I write C space coupon. If I try to give a name to this, Excel will store that as C underscore coupon. So any space or any special character is going to store as an underscore here. Okay. Uh, Now, what is the use of this? The use of this is we don't have to freeze the cells when it comes to referring back to the assumptions. We can directly use. For instance, if I want to find the coupon, that is nothing but coupon percentage into par value. So I can just write this, and even if I drag it anywhere, I don't have to worry about my cell freezing. For instance, if I had not used names and if I had written this formula, C percentage into par, and if dragged it, then so I'll write it again. G So if I were to write a formula like this and then drag it, can you see the values change because the referencing is to different cells? So then I would have to freeze the reference to cell G2 and G4. So typically when I don't use names, I'll have to do this. I write this, freeze the reference, say write G2. I freeze the reference to G2 by putting a dollar in front of both G and 2, then multiply by G4 and freeze that cell. And then if I drag it, then it will not change. It will remain at 10. So in order to use the same assumptions across my valuation exercise, I will generally take all my assumptions together and give names to those assumptions so that I can use those assumptions anywhere. So that whenever I don't have to use cell addresses like G2 and G4, now my formulae make a lot of sense because C underscore means it's a coupon rate and par means it's a par value. So whenever I look at my formula, they make economic sense. The second important, use of this is that whenever I change any of these assumptions, suppose I make this as 20%, what happens is that automatically these values are going to be updated. So if in my model, if I'm using, say, the coupon rate or the par rate at 10 different places, I don't have to worry about going to every cell and changing that. Automatically, it will change because all my assumptions are putting them together. And if I just change the value of those assumptions, everything changes. And that's the importance of using these names. So in any financial model that we create, we will always use names and we will give values to those. Okay, so right now, this is where we are. I'm going to delete what we don't need. So coupon has been done. Now, coming to the cash flow diagram. So I'm going to put this in Excel. The years will be in one column. The cash flows, which are all these futuristic cash flows, will be in the next column. And then we will find the present value of those cash flows in the third column. So the years, there are 5 years. So I will just make that as a sequence here. So I'll have to type 1 and 2, and then I'll have to drag it to get till 5, the same sequence. You can also write a simple formula in Excel called a sequence, in which you can say, okay, I want rows. Say I want 5 rows and I want to start with 1. Okay. So right now I already have these values. So hence it's giving me a spill error, but I can also use the sequence formula to populate. Yeah. So it gives me 1 to 5. So suppose if I were to tell you, okay, I want to in one column write 1 to 10,000 in column K. So obviously this is a very inefficient way of doing it. I can write 1 and 2 and then I can drag it, but you can't keep dragging it, right? Till 10,000. It's inefficient. So hence we have this formula sequence which does the trick if the number of these years are too large. But in generally in a fixed income case, generally the years are not so large. But this is a good way. Say in simulations, whenever you run simulations, you need to write the sequence in terms of what is the simulation number. So there, these sequences, large number of sequences are have to be simulated. So there, the sequence formula is good to use. Now the cash flow is nothing but, can I say, if I look at the cash flow diagram, every year I get the coupon. In our case, can I say the coupon is this? I've already named it as coupon. So what I'll do is I'll say equal to coupon and I'll drag it down. Plus in year 5, along with the coupon, can I say we also get back the par value of the bond? So I will write coupon plus par towards the end. Yeah, so that's the 5th year's cash flow. And to find the present value of the cash flow, I take the future value and divide it by 1 plus R. What is my R? The interest rate to be used or the yield is to be used is R. So 1 plus R raised to I, which is the year. So we are going to use this formula, which is the present value n formula. So future value nth cash flow divided by 1 plus R raised to n is going to give me the present value of that nth year's cash flow. And that exactly is what we're going to use here. So, and I'm making it generic because I'm raising it to I, which is the year. So if it's a 1st year cash flow, I'll raise it to 1. Now, if I drag this formula down, automatically it will be raised to 2 because it's the year 2 cash flow and so on and so forth. So I'm writing one generic formula. I'm raising it to I and I'm just putting it down. Yeah, so these are the present values of all the cash flows. And if I ask you what is the price of the bond, price of the bond is very simple, the summation of all these values, right? So I can just sum these, and the price of the bond is 100 today. Okay. So this is how bond valuation you can do in Excel. So this is a longer method and it's called as the tabular method of pricing, in which we will detail out the years, the cash flows, the present value of cash flows, and then just sum them up together to find the price of the bond today. So price of the bond at 0 is going to be 100. So this is a tabular method of pricing. Any questions on this? Anyone? Okay. I can also use PV function to find the price of the bond. So let's use the PV function. PV function will have the rate. So rate is R in our case, which is 10%. Next thing is number of periods, which is 5, which is, I can call it by TTM. Next is the PMT. PMT is nothing but constant payment every year. Can I say constant payment every year is what? The coupon. So that's the coupon. Future value. Okay, so what is the future value? Can I say that is the future value is nothing but what you get towards the end, which is the par value. Okay. So I can write that as par if you want. And that will fetch me the present values of 100. Minus 100 because what Excel does is that if you define future value as positive, it will fetch you a negative PV. And if you put the future value as negative, it will fetch you a positive PV. So the way in Excel the function works, the PV function is it inverts the sign of FV and PV. So if you give FV as positive, it will give you a negative PV. So once again, this is the formula. Rate, which is the yield on the bond, then the number of periods, which is time to maturity, then comes the constant coupon, which you earn in absolute dollar terms. Then comes the future value, which means in this case, the future value of the bond is always the par value because that is what is returned back to the investor by the issuer. And then you have type. What is this type? Type means what kind of cash flows are these? Are these end of period or beginning of period cash flows? So generally, we consider cash flows at the end because if you clearly see the cash flow diagram here, can I say the interest payment is or the coupon payment, can I say is received at the end of year one, not at the beginning of year one. Okay, these constant cash flows are always towards the end. Yeah, so hence by default, if you don't put the type, it by default takes 0, which is the end of the period. If you want to give beginning, then you have to explicitly give 1. If you leave it blank, it will take it as 0. Okay, so this is the same as what we have gotten here. If you want a positive answer, you'll have to put a negative in your future value. Then you'll end up getting a positive answer. Okay. Any questions here? Anyone? Okay. So this is the present value formula to get the price. So two methods for finding price. One is this tabular method, get present value of every cash flow, or use this formula, which is the PV formula. The third way of course, is in your on your exam, you would need to use calculator. So the financial calculator is you will have to key these values. So N will be 5, I by Y will be 10, PMT will be 10, FE will be 100. And based on that, it will fetch you the PV. So you need to compute PV. So then once you key in everything, you'll have to press CPT and then it will fetch you PV as minus 100. Very similar to how Excel works. If you give positive FE, it will fetch you a negative PV. Yeah. So that's the reason behind why you see this value as negative. Okay, so three methods of doing this. One is on Excel, two methods, tabular, then your present value formula, and then you can also use the Calci financial calculator, key in these values, and then find the price of the bond. Okay. Now, this is how the price of a bond is calculated. Now, I also told you that the the rate will fluctuate. Okay, which means that this rate, which is also called as the yield on the bond, when the bond trades in the markets, this yield will fluctuate. Every day it will change. So if create a diagram of yield versus time, yield is going to change every day. Okay. Now the question is, if the yield changes, say from 10% to say 8%, or which means it goes down in this case, or if it goes from say 10% to 12%, which means it increases in the second case, in the second scenario, then what is the impact on price, right? So let's calculate that and put it very simply here. Okay. So can I say I'll just create a small table here where I put yield. When the yield was 10%, which is the initial yield here, can I say my price on the bond is 100, which we calculated. Now, if suppose I say yield falls to 8%, then what is the price? So all that I have to do is I have to just go in my pricer and change the yield from 10 to 8%. Please note, don't change the coupon. We are changing the yield or the market rate. If that changes, look at what happens to the price. It increases and becomes 107.98. Okay. And if I make it 12%, the market rate, then the price of the bond falls to 92.79. Now, this should be intuitive. When I make the yield fall, the price is increasing. And when I make the yield rise or the market rate rise, the price of the bond falls. And that's because of this formula, which we looked at some time back. If you clearly look at this formula, I'll just paste it on the Excel. So when we look at this formula, can I say that my R or the yield on the bond is in the denominator? Yeah. And the price is here, right? So can I say price somewhere is inversely proportional to yield or to the rate? Yeah. And hence, when the rate falls or the yield falls, the price of the bond increases and vice versa. So in bonds, there's always an inverse proportionality of price and yield or price and rate on the bond. Okay. So this is how we do it. Okay. So here we have created these scenarios, two scenarios wherein we are making the yield fall, and the other scenario where we are increasing the yield. Now, if I tell you that, okay, I did it manually, right? I went here and changed these yields. What if I ask you to do scenario analysis of a number of scenarios? So in these scenarios, we specifically say that the yield on the bond or the interest rate on the bond, say, changes from say 3% all the way to say 20%. And if I want to find the price of the bond here for all these yields in one step itself. So here what I did was initially, can I say the yield was 10% and price was 100? So I noted it here. Then at yield 8%, I went here and changed it to 8%, right? And then the price changed and I noted it manually. Now, I'm telling you that there are so many different scenarios. Suppose if I want to do, and I don't want to do it manually. So there's a one step procedure through which, or a process through which you can find the price for all these rates. So suppose I put price here for all these rates and the prices here, the way this works, the scenario analyzer in Excel is on the header. where you've put the rate header. Suppose I put rate here. Next to that, next column, you make. So can I say in the next column, I want the prices? Where are the prices of the bonds? Can I say ultimately the prices of the bonds have been put up here, right? In the sum. So this is where I've written the function. And next to that rate header, I will put the function which is equal to where I have written the price of the bond, which is this. So this is the main formula because this is the formula where it sums up all the present values. And hence, what I've done is in the scenario analyzer, this small table which I'm going to create, I'm writing the base price function on top equal to H113. What is H113? H113 is the cell which stores the summation formula for the entire price of the bond. So I need to link it to that cell. So I've linked my header to 100 here so that Excel understands that, look, if I change the rate, please find what is the price based on the formula which is in cell H13. So my base formula is in H13. And now what I do is I select this entire uh, area or table, and then I go to data, and then I go to what if analysis data table. And in this data table, again, I go to data. How did I get this? I go to data tab, what if analysis data table. There's a shortcut to this called as Alt DT, Alt data table DT. So when I press Alt and DT together, I get this shortcut. I get this dialog box, and it's asking me, where is my base variable? Now, what is the base variable here? What is changing? Can I say the rate is changing? And where is the rate defined? Can I say the rate is defined in cell G3? G3 cell is where the rate is defined. And hence, and can I say all those rates are defined in column P for me? All those rates which are changing 3, 4, 5, 6. Can I say those are defined in a column? So I will keep row blank. And since all these rates are defined in a column, the scenarios, I in column will give the input cell. What is input cell? Input cell is the base assumption for rate. And where's the base assumption for rate? It's here. This one. The formula where we get the price in H13 is using the rate from the cell G3, and hence I give G3 here and I press OK. As soon as I press OK, you see that you get the entire matrix of rates versus prices. And suppose the rate becomes 3%, the yield falls to 3%, the price of the bond will rise to 132. Okay, so this gives us the entire picture of the rate versus how the price evolves for that rate. Okay. Once again, I repeat this process. So in this process scenario analyzer, ahead of the rate, I will put what? Equal to the price, which is storing the value, the formula. And then I select the entire area for which scenario analysis need to be done. I press Alt DT, or I can go on data tab, click on what if analysis. Now the row is blank here because all my scenarios are in one column P, and hence in row I will not put anything, but in column I will give input cell as what? As the base value of rate, and the base value of rate is defined here in cell G3. And I press OK, and these will be all the prices of the bonds. So for all these yields, these are the prices. And if I now want to find the price yield relationship of this bond, I will select the X variable, which is the rate, and the Y variable, which is the price. Okay, price yield, if I want to graph out, it is always in the fixed income world given as price versus yield. Price is on the Y axis, yield is on the X axis. And that's what I'm going to do here. And I can just go on insert and insert a chart. So I can just use this chart. I can make a line chart, or I can make a scatter plot. So here I make a scatter plot, and this is basically giving us the inverted yield price yield relationship in a bond, which clearly states that if the yield on the bond falls, the price will rise. On the other hand, if the yield on the bond increases, the price falls. So this is the price to yield inverted relationship. Any questions here? All okay? Scenarios, analyzer.
Yes, sir. All okay.
Okay. All right. So if this is okay, let's look at solving one or two problems. Okay. So if you guys can attempt this problem. One second. Uh, okay. Actually, you can attempt this. Sorry, you can attempt this problem. Now, one more thing which I would like to highlight before you attempt that problem. Whenever a bond trades at 100, which is the par value, that is called as par bond. So when the yield on the bond is 10%, the bond trades at par, which is 100. So you can also clearly see the relationship between the coupon rate and the yield. The rate or the yield is here in this column. Coupon rate is always fixed at 10%. As soon as the yield falls, the yield is falling here, okay, below the coupon rate. So whenever C is greater than Y, you see that the bond is trading above 100. So that kind of a bond is called as a premium bond. And whenever the yield goes above the initial yield of 10%, whenever the yield rises above the coupon rate. So here the coupon rate was 10%, but the yield say rises either 11 or 15 or 20, whatever that is. So clearly the coupon rate falls below the yield in that case. And if that happens, the price of the bond goes below the par value. And hence we say that the bond is quoting at a discount. So whenever I tell you the bond is trading at par, it basically means that the coupon and the yield are the same for that bond. Whenever I tell you a bond is trading in premium, it means coupon is greater than Y. And whenever I say that the bond is trading at discount, it means coupon has fallen below Y or yield has gone above coupon. And this is because of the simple formula which we have here. Okay. Same formula gives an explanation for this. Your coupon is part of your PMT, right? How did we calculate these constant payments? These were nothing but coupons. So when I write the present value formula, can I say in the case of this fixed rate bond, it becomes C upon 1 plus R plus C upon 1 plus R square, so on and so forth. And in our case, it was a 5-year bond. So C plus par divided by 1 plus R raised to 5. R can also be called as yield, Y. You can also call this as Y. And clearly, if you can see, coupon is in your numerator and your yield is in your denominator. As soon as numerator and denominator are same, it becomes par value. As soon as numerator goes above denominator, it will trade above par, premium bond. And whenever numerator goes below denominator or denominator rises above numerator, it becomes discount bond. So this is the philosophy behind par, premium, and discount bonds. Now, with that background, you can solve this question, please. So there are three questions attached to this. Which bond trades at par, right? When I look at this question, this is what is given to us. Calculate the price of the bonds per 100 in par value. So par value basically is 100. This is telling us what is the coupon rate. This is telling us the maturity. And this is the market discount rate, which is nothing but your yield or rate on the bond. There are four bonds here. So which bond trades at par? Can anyone tell me? C. And that's because the coupon and the rate are the same, right? So wherever the coupon and the rate are the same, that bond trades at par. Okay, that's C. Which bond trades at discount?
A and D, right?
C less than Y, right?
Yes, sir.
Yeah.
So
A
A and D. Okay. So answer is C again. And what is the price of bond A? So for this, coupon is 2, time to maturity or number of periods is 6,
94.58.
94.58, yield is 3%, par value is 100,
94.5.
94.58. Devansh, are you getting? Just check. Okay, so 94.58 is the right answer. Yeah, so this is a small caselet on bonds trading at discount, premium, and par, something which we have just covered. Okay, so these are the basics of bond valuation. Let's go to the slides. So we are done with this. We are done with price sensitivity, premium versus discount. We are done with this price yield relationship. It's an inverse relationship. Also, we also say that the bond instruments are convex in nature, and I will just explain this why we say that, and that's important because in the next session when we talk about bond price sensitivity in terms of duration and convexity, we will revisit this concept. So we say that the one second, yeah. So what is this convex? Why are we saying bonds are convex in nature? So when I draw the price yield graph, the price yield graph looks like this. Okay, it's a non-linear curve. It's not a straight line. If I were to draw a tangent at this line, it will showcase a straight line like this. So if it were a linear relationship, had the yield say fell from say 10% to maybe say 7%, can I say the price of the bond would have been this? But actually the price of the bond is this. So this is the actual pricing of the bond and this is linear assumption. So clearly since bonds are non-linear, why are bonds non-linear? Because if you see the formula, clearly this is non-linear, right? These has squares, cubes, etc. in the denominator. So it's a non-linear pricing. So hence, because of non-linearity, there is a difference between the linear assumption and the actual price. So if the bond price falls, if the yield falls on the bond, the price of the bond increases beyond what is given by the linear approximation. And hence this part, can I say, is the extra rise in the price of the bond. And that's what leads to convexity. Also, similarly, when the yield rises, say to 12%, if this gives us the linear approximation, but actually the bond price doesn't fall as much as what the linear approximation tells us. So can I say this is the cushion? Or this is also giving us the impact of convexity. So convexity of bonds means that when the yields fall, price rises more. And when the yield rises, on the other hand, the price doesn't fall as much. So there's always a cushion here when the yields rise, but when the yields fall, the price rises by more than what the linear versus linearity. And this is why we say bonds are convex in nature. So this is the convexity of bonds. How to calculate this part, we will see in the next session. So that's calculated using convexity of the bonds. Okay, so those were the simple basics here. So price yield relationship
So,
also, yes.
can you repeat the last line?
This one, convexity.
Yes.
Okay. So convexity, so suppose I tell you that bonds are linear. Okay. If the bonds were linear, they would have followed this linear negative slope assumption because bonds are inversely proportional to yield. If I look at the pricing of the bond, right, versus yield, when I look at this formula, okay, this formula is not a single degree formula because especially if I look this at this 5 year pricing of this bond, can I say there are squares, there's a raise to 5. So it's not a simple linear relationship between price and yield. Actually, it's an inverse relationship. And hence the bond pricing will not give you this straight line. For instance, when I also look at this graph which we drew right here, although it looks like a straight line, but it's not a straight line. It's a curve. It's a curve, and I can say that. 1 second. Yeah, so now this is more visible. Now what I've done is I've just changed the scaling of the y-axis, which is the price. And as you can see, if I were to draw a tangent at say 10%, the tangent would look like this. So clearly, the tangent is the linearity assumption. But when the bond yield falls from say 10% to 5%, linearity assumption linearity assumption is telling us that the bond price would have been here at this point, but actually it's here, it's higher. So when the yield falls, the bond price increases more than what is given by the linear relationship because of this non-linearity, which is the convexity in the bond. Similarly, when the yield rises, suppose yield goes from 10 to 15%, the price of the bond should have fallen here, but actually it's fallen less. It's the blue line. That's because of the convexity. So the convexity means that it's good for the bond investors. Convexity is always good for the bond investors because here we have something called as positive convexity. This is good for investors. And why is it good for investors? Because of this. When the yield falls, price rises more. And it's an asset for you, right? The bond is an asset for you. So if the yield falls, price will rise more, which is good for you. But if the yield rises, the price is not going to fall as much as what the linear uh, price relationship suggests. But actually, since the bond is non-linear function of yield, its price will not fall as much. And the positive convexity helps us in both cases. Even if the yield falls or the yield rises, it doesn't matter. Yield falling or yield rises, it doesn't matter. Positive convexity is good for investors because in the first case, price increases more. In the second case, price does not fall as much. So that's the positive convexity of regular bonds. Better?
Yes, sir.
Okay. All right. Not all bonds, by the way, have positive convexity. Some bonds have negative convexity. Okay, we'll look at that in the next session. But right now, uh, convexity helps, and that is what we were discussing here. There is something called as a pull to par effect. What does that mean? It means that as soon as the bond reaches maturity, so on this graph, bond price is on your y axis and the time to maturity is on your x axis. So when I look at the cash flow diagram of a bond, right? Any cash flow diagram of a bond, can I say that at maturity, what should be the price of the bond? At maturity? Can I say you receive everything except for the face value of the bond? So the price of the bond should be nothing but the face value of the bond, 100, when there's no time left. Okay. So hence every bond at maturity will have to go back to its face value. And hence there is something called as pull to par effect. Because at maturity, the bond value is always equal to par value or face value. So if we consider premium bonds where the coupon is greater than the yield on the bond, also called as yield to maturity, can I say that the pull to par will be from up to bottom because the bond will trade at a premium, and as the years pass, this premium will decrease. So suppose if only 1 year remained to maturity, the price of the bond will not be 110. It will be close, probably below 105. And at maturity, it will fall to 100. Similarly, if it's a discount bond, it's in deep discount at say 3 year before maturity. But at 2 years, the discount will reduce. At 1 year, the discount reduces further. At maturity, there's no discount because the price of the bond pulls to par or becomes 100. So this is the evolution. If nothing else changes, there's a pull to par effect, which means your premium bond is going to fall to a par value at maturity, and a discount bond, which is below 100, will rise up to the par value at maturity if nothing else changes. So this is the regular impact of a bond which trades till maturity, and that's called as pull to par effect. So price has to converge to par at maturity, whether it's a premium or a discount bond. Any question here? Okay. Let's go ahead and talk about what if we have different frequency of compounding. Till now, we have dealt with annualized frequency of compounding, but what if I say that now there is, say, semi-annual or a different frequency of compounding? So whenever you have different frequency of compounding in a bond, what you need to do is, can I say these are the various assumptions in a bond? Time to maturity, then you have the coupon rate, you have the yield on the bond, and you have the par value. Now, what changes in a bond is when there is frequency. Suppose frequency is annual initially, no problem. In our case, can I say it was 10%, 5 years to maturity, yield also was 10%, par value was 100. Now, suppose if we say that uh, the frequency of compounding now is not annual, it becomes semi-annual. If I were to draw a cash flow diagram here of the coupons, so can I say every year we are receiving annualized coupons? And those are 10, 10, 10, and so on and so forth. When I say semi-annual compounding, which means the compounding is every 6 months, so the cash flow diagram will change. And can I now say that every 6 months I'm going to receive coupon every 6 months, and that coupon will not be 10, it will be 5. Now, instead of receiving 10 at the end of the year, I'm saying you receive 2 of 5 each for 6 months, 6 months after every 6 months. So total coupon remains the same at the end of the year, but these are distributed. So you receive 5 at the end of 6 months and 5 at the end of 1 year. So how did I get this? I got this because if 10 is the coupon for the entire year, clearly for 6 months, what is the coupon? Coupon will be half, right, of that. So for every 6 months period, coupon will be 10 by 2, 10 by 2. And hence, whenever we have compounding in our bond problem, we will always divide the coupon by the frequency. In this case, frequency was 2. So my coupon rate became 5% on the par. And similarly, the yield also will have to be divided by 2. So whatever your yield is has to be divided by 2. And can I say now, instead of 5 payments, can I say if there are semi-annual payments, every year I receive 2 semi-annual payments, right? And 5 years. So can I say totally how many payments I receive? 10 payments. 5 years into 2. because every year I receive 2. So I receive 10 payments. So whatever your time to maturity is, you need to multiply by F, which is your frequency of compounding. In our case, it was 2. So 10 periods. So now your problem changes from 5 years to 10 periods, from 10% coupon annual to 5% periodic coupon, and to a yield of 10% annual to again 5% periodic, which is every 6 months. In semi-annual compounding, periodic or base period becomes 6 months. Okay. And this is exactly what I will now be using in my formula. So crux is that whenever you have frequency of compounding, increase your time. So time periods obviously increase because the number of buckets increase, bucket size decreases. So number of periods will increase and your coupon and yield will fall. Okay, you need to multiply by F and you need to divide by F. All the rates you will divide by F. The time period you will multiply by F. So these are the two adjustments which you need to make. So in our case, let's go to the Excel and let's see how it looks like. So here we have, here is where I will do semi-annual. Okay. And I will use the pricing, which we did here. Okay. So here I will write PV is equal to rate. So what rate will I use? Now, instead of the rate of 10%, we will use 10% by 2, comma. Number of periods initially were 5 years, but now will have to be scaled up by F, which is 2. PMT, what is PMT? This is the annualized coupon, right? Again, scaled down by F, which is 2, semi-annual. Future value remains the same, so no problem there. That is your par value. Other things remain the same. So since C is equal to R in our case, again the price of the bond will be 100 only, which is par value, par bond, because both coupon and yield is the same. So even if we have frequency of compounding here, it doesn't matter. But if I change, say the relationship between C and R, then the price of the bond will also change. For instance, let's make this as 8%, or rather the coupon remains at 10%, but let's change the yield to say 12%. It becomes a discount bond. Annual coupon assumption is going to give me a price of 92.79, but semi-annual is going to give me 92.64. So can you see the difference in price? And this difference in price is because of the frequency of compounding. Also note that the price of the bond is falling more in the case of frequency of compounding. So that's another rule which you can make a note of. Whenever your frequency of compounding, which is denoted by F, okay, clearly semi-annual case F is 2, quarterly compounding F becomes 4 because now you divide the year into 4 quarters. Monthly compounding F will be given as 12. Now, if the frequency of compounding increases for discount bonds, the price of the bond will fall more. On the other hand, for premium bonds, the price of the bond will rise more. Opposite effect. And that is evident here because here, as I said, the price of the discount bond. So now this is a discount bond, right? Because your yield is bigger than your coupon. So in a discount bond, annual compounding gave you 92.8, but semi-annual is giving you a lower price, 92.64. If I were to make this as 8%, the yield, note that annual is giving me 108, but semi-annual is giving me bigger price, 108.11. And that is the impact of frequency of compounding. Higher the frequency of compounding, more is the price fall for discount bonds, and higher is the price rise for premium bonds. Question? All
No,
okay
sir.
till here? Okay. Okay. So we are through with the compounding. Yeah. All right. There is something called as yield to maturity. What is yield to maturity? It is nothing but what we had considered here, the yield on the bond. Okay. This rate R or yield on the bond is called as yield to maturity if we assume that we are holding the bond till maturity. Okay. So in this example, for instance, I know everything, but I don't know the yield. I know so find the market rate or find the YTM of the bond when price is known. Till now, everything else was known, but price was unknown today. In all these examples, right? We knew the yield, but we did not know the price. Now, if I tell you, I reverse the problem. I tell you that I know the price, but we don't know the yield. And that is what is given here. So the inputs are N is 10, PMT is 5, which means coupon rate is 5%. Future value, which is par value, is 100, and present value of the bond is 105. So with these inputs, we would now want to calculate what is the yield to maturity. So same way you can calculate yield to maturity. So on your calculator, you can put all these. Then you can say compute I by Y, and I by Y will give you 4.37%. Please note, it's a continuation of the previous problem, which means we were assuming semi-annual compounding. So whatever yield you get is a semi-annual yield, and you need to multiply that by 2 to get the annualized yield. Annualized yield is also in bond world called as bond equivalent yield, BEY. That's the annualized yield. So whatever yield you get from your calculator or from your Excel, you would need to multiply that by frequency to get the annualized yield, which is called as bond equivalent yield. So whenever you get a problem on BEY, it means it's a bond equivalent yield. Okay. So in a problem, either price could be unknown. If that is unknown, then yield will be given. Otherwise, if you want to find the yield to maturity, then price has to be given to you. In this case, all these are knowns. What is unknown is yield. And here we are trying to calculate yield using the calculator here. Okay. Any questions? Also, please note on your calci, you need to give different signs to your present value and future value. Please don't forget that. Only then yield will be calculated. Otherwise, it will not calculate. So one has to be positive, the other has to be negative cash flow. Okay, so this is calculating yield to maturity. Uh, there's a concept of accrued interest. Okay, let me explain that quickly. What is accrued interest? Very important concept in bonds and very much applicable in the real world. Accrued interest is a concept which is very straightforward. So suppose it's a semi-annual bond, okay? Suppose the last coupon was given out, say, on the 1st of August. Okay. Can I say when is the next coupon going to be given out? After 6 months, right?
Yes,
So
sir.
when is that?
1st February.
1st Feb. Okay, good. And then after that again on 1st August of the next year. So this is suppose 2026. This will be 27. This will be 27, correct? Now, suppose that there's an investor who, say, receives some investor is someone who holds the bond, right? Now, investor has received the coupon on these fixed coupon dates. All these are fixed dates on which you receive the coupon. Now, suppose the investor says that, okay, maybe after 3 months, the investor feels that they do not want to hold the bond any longer. They want to sell the bond in the market. Now, when they go and sell the bond in the market, the bond price which is quoted in the market is called as a clean price. So this is called as the quoted price, quoted market price of bond. This market price doesn't take into consideration that you have held the bond for 3 months. Can I say that the investor, since the investor has held the bond for 3 months, which means the investor is planning to sell the bond on the 1st of November. So the investor is, can I say, liable to get the coupon for 3 months because it has held the bond for 3 months. But in reality, the next coupon is only on 1st of Feb. But as a concept, theoretically, can I say the investor is liable or should be getting a 3 month interest or a coupon payment, right? But the next coupon payment is only on the 1st of Feb. And hence this concept of accrued interest. What does accrued interest say? It says that from the last coupon payment till your selling date, whatever are the days to which you hold the bond, you should get the interest, the coupon for that pro rata based on the period which you hold versus the period between or the coupon frequency, which is the period between the last payment and the next payment. Okay. So in this case, can I say we hold the bond for 3 months, but the next coupon from the previous coupon is only after 6 months. So can I say I'm liable to get a fraction of the semi-annual coupon? Actually, the coupon will only be distributed on 1st Feb, but since I'm selling the bond, I'm liable to get this accrued interest because I'm selling the bond which I've held for 3 months. So I'm liable to get interest for 3 months. And can I say it will be pro rata based on how much period I hold it for? So this pro rata is nothing but a percentage of the coupon. And this percentage is what? This percentage is determined by days held divided by period between coupons. In our case, can I say days held is what? 3 months. I hold it from 1st August to 1st November. I'm selling the bond on 1st November. So I hold it for 3 months. So that's my days held. But can I say period between coupons is 6 months? It's a semi-annual coupon. So can I say I should ideally get half, 50% of the semi-annual coupon? So this is my accrued interest. This into my coupon uh, uh, the semi-annual coupon is going to fetch me my accrued interest. In this case, I took a very simple, easier calculation. I could took 3 months divided by 6. But had it been 1 month, suppose if the investor is trying to sell on the 1st of August, so can I say in that case, accrued interest would have been 1 month divided by 6 months into semi-annual coupon. So that would have been 1/6 of the semi-annual coupon. So number of days held divided by period between coupons is the accrued interest. Any question here? All okay. So this is the accrued interest which the uh, investor of the bond is liable to get. What is quoted in the market is always not having accrued interest calculation. That's called as clean price, which is the quoted market price. On top of that, you need to add accrued interest. And once you add that price of the bond, which has the quoted price plus accrued interest, that is called as dirty price of the bond. Okay. So the difference between clean price and dirty price is whether accrued interest is added or not. As soon as accrued interest is added, it's called as dirty price. So these are the basics on accrued interest. Dirty price, also called as full price. So that is your flat price or clean price plus accrued interest. Accrued interest is the interest which the seller or the investor of the bond should earn based on the period of bond held since the last coupon date. So this period divided by this whole will give us the percentage held and multiply by the coupon. So that will fetch you accrued interest. So this is the fraction which I'm talking about, days from last coupon to settlement and divided by days in between the coupon payments. Okay, this, by the way, there are two conventions which are followed when we talk about accrued interest and other kinds of conventions used in the bond markets. So generally a 30 by 360 convention is used for corporate bonds. What does it mean? It means that we are assuming every month has 30 days and the entire year has 360 days. So that's called as 30 by 360 convention. And this is basically the GSECs or the government bonds usually have actual by actual convention, which means it's actually the actual number of calendar days divided by the actual days in the period. Okay, so actual by actual is for government bonds, 30 by 360 is the convention for corporate bonds. How will the difference happen? So here we are taking a simple example. It's a 4% annual pay bond, which means the coupon rate is $4. Last coupon was made on 15th of May. Say the settlement of this is on 10th of August. What is the settlement? It means that it's planning to be sold on this date. So this is the selling date for the bond. So can I say last coupon was 15th May as a cash flow diagram? This is when you received your last coupon. Can I say next coupon you will only receive on 15th May of the next year, right? But now you're trying to settle the bond or you're trying to sell the bond in between. So August 10 is your settlement date. Okay. Now they're asking what is the accrued interest. So can I say it should be the fraction of the period held, a fraction of the coupon for which you hold it for the period between May 15 to August 10. So if I take 30 by 360 method or convention, every month we only consider 30 days. So May will have 30 minus 15, 15 days. June will have 30, July will have 30, and August will have 10 days because the settlement is on 10th August. So when I add all these, we get 85 days. So accrued interest will be total days held, which is 85 according to this method, divided by 360 into 4. 4 is what? My annual coupon. So this is the accrued interest which the seller should receive or the investor of the bond should receive apart from the quoted market price. So clean price plus accrued interest is what the seller should receive. Okay. So that is what is accrued interest calculation for 30 by 360. In actual by actual, we take the actual days. So in May, we have 31 days. We started on the 15th, so there are 16 days in May. In June 13, July 31 actual, August 10. So these total to 87 and 87 divided by say 365 total number of days in the year into 4 will fetch me accrued interest. So as you can see, accrued interest calculations will differ based on my method of calculating the interest, whether it's 30 by 360 convention or actual by actual will slightly vary my accrued interest calculation. So there's a slight variation, not much, slight variation depending on the market convention. So this is the market convention for accrued interest calculations. It's a distinguish. How do you do it for 30 by 360 versus actual by actual? Okay. So what do you need to do? Suppose if you're given a problem like, okay, we have the 5% bond. What is 5% bond? It means this is your coupon rate. And you're given semi-annual, which means it becomes a $2.5 coupon. Par is 100. YTM says 4%, and your settlement is 4th of August. And say June 15 was your last date. So how will you calculate? Then you will, use your PV formula, okay, in which we say N is 4. And why N is 4? N is 4 because it's a 2-year bond, okay. PMT is, so here I'll write 2-year bond. PMT is 2.5, and that is because that's your semi-annual coupon. Par value is 100. and I by Y is 2 because the yield is 4%. Okay. If I give all of these inputs, I get a price on the bond. Okay. Now, this price on the bond is basically the price today, which is the price at the last coupon. If I ask you what is the price at settlement, one of the ways of doing this is using this formula. So you take the price on the last coupon date. If I draw the timeline here, last coupon date in this problem is 15 June. The next one will be after 6 months, the coupon received. But I'm trying to settle or sell the bond before that. So I'm selling the bond on 21st August itself. So this is the selling date on the bond or the settlement date. And the number of days are 67 from this. And totally say there are 183 days. So clearly this is actual by actual, which is, it seems they're trying to follow the convention. And how will you get the price of the bond on 21st August? So you can take the last price, which is the price of the bond on June 15, and multiply that by a compounding factor, which is 1.02, which is your YTM, and raised to 67 by 183. So that's another method of calculating accrued interest. So one method is what I showed you, which is using this formula, days between last payment and settlement divided by the difference between any two coupon dates into the regular coupon payment. So that gives you accrued interest. Here we are using compounding formula. Another way of doing it, another method is using this formula, which says that, okay, you take this yield and you raise it to 67 by 183. So can I say I'm increasing this beyond 101 because this is greater than 1, and hence the full price received will be slightly higher. Okay, so this is how we can also do it. Yeah. And how do we derive the flat price? So full price becomes 102.645. Your accrued interest in the same period is 2.5, which is your semi-annual coupon. Same problem this is, semi-coupon into 67 by 183. Those are the number of days divided by days held by the bond divided by a 6-month period. So this becomes my accrued interest. So what is my flat price or clean price? Clean price is full price minus accrued interest. So full price is what we calculated on the previous slide as 102.645. Minus of this will fetch me this price, 101.73. So this becomes my flat price or clean price. Yeah. Why do you think markets quote flat price or clean price? Why do you think markets quote flat price? Otherwise, there will be no way to standardize, right? Because accrued interest could be different for different people, depending on what is when are you trying to sell the bond. So to compare between different bonds and to remove the impact of accrued interest, which is a function of when was the last coupon payment made, we have markets which quote clean price, which means we eliminate the impact of whether the last coupon was received 1 month back or 6 months back or 1 year back. It doesn't matter, because now the price which is quoted is not including accrued interest, and it's not important when the last coupon payment was made. Okay. So hence, to compare bonds of different prices and to create a more uh, proper smoothing effect, we quote something called as clean price. So flat or clean price are going to smooth out the sawtooth pattern, which is generally seen in dirty prices. So when you quote dirty prices, it also includes accrued interest, and that will create a sawtooth pattern, which means that initially it could create a pattern like this because initially the accrued interest is low, but as soon as you hold the bond for more number of days in the coupon period, your accrued interest will rise, and hence this sawtooth impact. Yeah, so hence this to smoothen the prices. So this is the dirty price evolution, but to smoothen the prices, the market actually uses clean prices. So that is what this means. Okay, and I think we are done for today. We will continue next. In the next session, we are going to talk about. So I want to introduce accrued interest calculations on the Excel sheet, which we're going to do, and then we are going to move to interest rate, different types of yield calculation. We are going to look at different types of curves, spot rate curve, forward rate curve. We'll be doing those concepts, and then we'll move on to sensitivity of bond pricing with respect to duration and convexity, which means how to calculate how much convexity a bond holds. So we'll do all of those in the next session. Any questions?
No, sir.
Okay, before we go, let's see if we can do one more problem. Yeah. Okay. Can you guys solve this and tell me which bond offers lowest yield to maturity?
Is it A?
Okay, how much are we getting? YTMs? So how will we solve for this? For instance, on Excel. So we can use in Excel, we can use the rate formula. Let me go back to the sheet. Okay. So we can use the rate formula, which helps us calculate. For the first problem, number of periods is 2. PMT is 5. Assume that it's annual, if not given. What is PV? Price given is always PV. Today, price today, which is this. What is future value? 100 par value. Give minus 100. And your rate becomes, say, 6%. 5.86%. Is that so? Or you can do it on your calcs, that is better. Can I say for bond B, it's direct, it's a par bond, right? So YTM has to be 6% only. coupon rate has to be equal to yield. So here it is direct. YTM is 6% for bond B. Bond A is trading at premium, right? So coupon rate has to be bigger than yield. Yes or no?
Yes, I think so. It will bond A only.
And a bond A only, right? So coupon is greater than yield, right? For the first bond, it's a premium bond. So yield is less than 5%. And for bond C, if you look at it, it's a discount bond, right? So coupon is less than yield. Coupon is 5%. So yield is greater than 5%. So out of the three options, there's only one option which is less than 5. So clearly A has the least. So you actually don't even need to find the YTM using calculator. By relationship, directly answer is A. Lowest YTM. Yes, had it been highest YTM, then you need to calculate. So if I ask you what is highest YTM, how will you calculate? What is the answer? Sorry,
C, right?
let's see. How much is the YTM in C? So rate, number of periods for the third bond is what? 3. PMT is 5. Coupon. PV is what? Minus 97.327. Future values say 100. Type it's assuming end of period. So 6% exactly is your YTM for the
It is
third bond.
minus 100 or 100,
Which one?
or the first bond A, because I'm getting an error.
Okay. Okay, let's do it again. Rate will be equal to period is 2. PMT will be 5. Coupon is 5 for the first bond. PV is minus 101.886. So now we are assuming to get the right yield, right? Assume that your PV is negative and future value is positive. So that this maintains the bond convention because in when you buy from an investor's perspective, you buy the bond, so initial cash flow is negative. At maturity, it should be positive. So that's what we are trying to follow here. So PV minus, but FV plus 100, and you get 4%. Is that what everyone is getting?
Yes, sir.
Yeah. So that's what you should have. For this bond, we do not need to calculate yield for the second bond B because you already have coupon rate and it's a par bond, right? So coupon rate will be equal to yield to maturity. But just in case if you still want to do it, okay, rate number of periods is 2 years for that bond B. PMT is 6. Present value is minus 100. Future value is 100, and you'll just get 6%. Yeah. So the answer for highest YTM, both bonds B and C have highest YTM, but lowest YTM is bond A. Makes sense? So in YTM calculations, just follow this convention in Excel and also in your calculators where you put PV as negative and future value is positive. Then you'll get a proper rate. Make sense? Yeah. So this
Yes,
is
sir.
another question which we have solved. So let's get probably we'll have a session tomorrow or day after. and we'll continue with this, and we'll try to complete the most of fixed income valuation and sensitivity by next session. Again, it could be a longer session, around a 2-hour session next session. Yeah. Any questions so far? I will give certain problems to solve in some time, so you all can solve it and see if you can apply these. I'm also going to share all these collaterals, whatever I've covered today. Yeah. Okay.
Okay, sir. Yes, sir.
Thank you. Take care.
Thank you, sir. Take care.
Bye.
Thank you, sir.
Bye bye.